Are you a real estate investor looking at an apartment building right now, wondering, are you getting a really good deal or are you overpaying for the property? On today's show, we're gonna show you how to analyze a property with our 5-2-1 formula. Welcome to Multifamily Long Beach, a show dedicated to financial independence and wealth creation through real estate ownership. I'm Juan Huizar, president of Sage Real Estate, market leader in 4-unit apartment sales and rent control expert. A lot of the investors we work with have the same questions, which you might have as well. One of the questions is, we're looking at an apartment building. Do we offer more than asking? Do we offer asking? Do we offer a little bit less? If we buy this, is it gonna give me a good rate of return? If I buy the property, is it gonna make me money at the end of the month or is it gonna make me lose money at the end of the month? I'm gonna help you answer those questions today. When looking at an apartment building, there's two categories that we need to focus in on. One are the numbers. Does the property make sense? And financially, will it make you money? There's the physical. What condition is the property in? Does it need work or is it move-in ready? They're both equally important. Today, we're gonna focus in on the financial. In order to analyze a property, we've developed our custom 5-2-1 formula, which involves 5 calculations, 2 investment strategies, 1 exit plan. Out of the 5 calculations, we're gonna start today with the gross rent multiplier. Assuming a case study where we have a 4-unit building, they're all 2-bedroom, 1 bath, and we're just estimating the rent all at $1,500 a piece. Under this scenario, we have $6,000 that it's producing a month. That's considered our gross rent. And obviously annually it'd be $72,000. We take that $72,000 and we multiply it times a multiplier. I've written some out where it's a 12, where it's a 13 and a 14. Great, that's a simple calculation. How do I come up with this multiplier? And that's a very good question because that's where most people get stuck on. So are you in a neighborhood that sells at a 12 times? Or are you in a neighborhood that sells at a 14 times? Now it's quite possible that you're under and it's quite possible that you're over. It just all depends on the market that you're at. This is where you might need a real estate professional who specializes in a certain neighborhood because the real estate professional is gonna derive the gross rent multiplier in that specific area. Some areas might be low. Some areas could be really high. So it's important that you apply the right gross rent multiplier. And again, that comes directly from the market. What is the market telling us? And if you're able to buy under the multiplier, then you're getting a good deal. If you're paying too much, then you're probably paying too high on the multiplier. That's one measurement. Part 2 of our calculations is referred to as the capitalization rate. They call it cap rate. The capitalization rate is the ratio between net operating income and the price of the asset. We're gonna use the same case study with our 4-unit building that we used already, where we're gonna make on an annual basis $72,000 in income. In order to arrive at net operating income, which is a very important figure for our ERB formula, we need to properly subtract the proper expenses. And so that would be vacancy, property taxes, insurance, utility costs that belongs to the owner, and repairs. Once we subtract the operating expenses, we arrive at net operating income. Now, one thing that's important to note is that we never include the mortgage interest rate within this deduction here. And so that's a mistake that I see done frequently, and then it would throw off your figures. And the reason why we don't include mortgage interest is because the interest that you have might be different than what I have. And so in order so that we're properly comparing apples to apples, that is not included in this calculation. So working from the net operating income, so this is what we're left with after we deduct the operating expenses, we're gonna put this into the ERB formula, which is net operating income over rate of return, which subsequently will give us value. So if you have 2 of these figures, we could come up with value of the property. So in this case, we're gonna take the $50,400, and let's just say that you want a 5% rate of return on your investment, okay? That's a great rate of return, and so what we're gonna do here is this would equal to a value of $1,008,000. Let's just say that the market that you are in does not pay that high. Maybe you're in a market that pays 4% rate of return. So then you take the same net operating income that we're pulling off of here, but now you're dividing it by 4%. This value is gonna be $1,260,000. I know I'm quickly going through this, but it's important that you're working with a professional that understands these values, someone that understands the operating expenses, but more importantly, what is the capitalization rate that is offered in different neighborhoods? Different states are gonna give you different rates of return. Different areas, like in Long Beach, different areas are gonna give me a different rate of return. And that's what I need in order to properly calculate value, is at what cap rate are certain properties trading at in the neighborhoods that they're in. Our third calculation is what we call kind of our price comparison. We're going to compare price per square foot and how does that compare to everything else that's selling around us. To be able to come up with this, you really need to know what are similar properties selling for on a price per square foot basis in the area that you're looking at. And so going back to our case study, in this case, we have 3,656 square feet. This specific property, when we compared it to everything else that's similar to in the area, they were selling at $300 a square foot. That's gonna give us a value. It's possible that this value changes in the area that you're in. Maybe you're at $100 a square foot. Maybe you're at $500 a square foot. So this one could simply shift, but again, that's market derived. Someone needs to know what they're doing and looking at the right type of property to make sure that you're comparing the right types. Equally important and kind of under the same umbrella is if we're not gonna look at price per square foot, because some investors don't care about that, they care about price per unit, or it's also referred to as price per door. How much am I paying for each individual apartment? In this specific case with our case study, we were at $275,000 a door, a unit, and that gave us a value of 1.1. This value, again, could go up and it could go down. And again, that's gonna be market derived. You need to work with a professional to help come up with these numbers. Our first three calculations, again, were the gross rent multiplier, capitalization rate, and our price per square foot / price per door. Those measurements are perfect for coming up with value of what are you gonna offer for the property that you're looking at. This next measurement is actually gonna look at the income that you're putting in and the cash flow that's gonna come out from that income. We call that cash on cash. So a very simplified version using the same case study is that if we were getting the annual gross of $72,000, now I am including our mortgage payment into this. And so we're gonna be at total expenses of $45,000. Our net income before tax is $27,000. In the scenario with our 4 units, we're assuming that the property would sell for $1.1 million and we put 30% down payment. So again, this is a ratio between the amount of money that we made, the cash flow, the $27,000, and the amount of money that we invested. So in this case, the amount of money we invested was the 30% down payment. It's a simple division, and we come up with the 8.18 rate of return, cash on cash. That means that you invested $330,000 and you generated $27,000 that year one. Whether this rate of return is good for you, it's gonna vary for every investor out there, but every investment is going to give you a different cash on cash return. And you as the investor need to decide, is this the best use of your money or are there alternative investments for you? Our fifth calculation is what we refer to as, does the property debt service? Will the property pay for itself after you buy it? So let's take a quick look. We have the annual gross, which the property is going to make. You're going to subtract the operating expenses. We walked through that earlier today. And then also we're going to end up, which leaves us with our net operating income. We still need to subtract the mortgage, which is going to be the principal interest payment that we're going to have to give the bank. We're going to end up with a number. If it's 0, that means you're at a complete break even. If it's positive, then the property is making income. It's what we call that it's a positive cash flow. If there's a negative, that means that you are not only going to put a down payment on this property, but you're also going to be paying every month to make up the difference. It's important to know where your property stands before closing escrow. Now that we've discussed the 5 calculations on determining value and rates of return and does the property cash flow, we're gonna move on to our investment strategies, the 2 options that you as an investor have. The number 1 question I get from folks who call me, Juan, I wanna buy in Long Beach, I wanna own property in Southern California, but it's so expensive. There's no rate of return that I'm gonna make. And then they'll say, should I buy out of state? So that brings me to my next point. As an investor, you're either buying for equity growth or cash flow. Take in Southern California, a lot of properties will not cash flow. Hopefully they'll debt service, but in Southern California, you are buying because our values keep going up and up and up. And what's driving it? It's our economy, it's our population growth. In other states, the values are much lower, so low that you will actually produce cash flow. Everyone wants both, right? You want the property to go up and you want it to make you monthly income. Unfortunately, it's really, really difficult to have both in the initial years of owning a property. So you need to decide, do you need cash flow or do you want equity growth? Our last and final step of our formula is what we call our exit plan. We're buying real estate to hopefully make cash flow, build equity, have it appreciate in value, and sell it at the very end. And we need to know, when is the end? Are we gonna own this for 3 years, 5 years, 10 years, or even longer? Are we looking at this to be our retirement? Is this generational wealth where you're gonna leave it for your kids? It's important to know your exit plan, because oftentimes we partner up with our friends or other investors to be able to gather our money together and go purchase a property. But parties need to be aware of how long are we gonna hold it, because the last thing you want is to sell a property prematurely. And believe me, because I've been in that situation where I've owned something with an investor and we've sold it, and now that I look back, it was a mistake. So knowing your game plan, how long are you gonna hold it? What is your goal? Do you wanna leave it for your kids? And if that's the case, you can't let market fluctuations change that direction, because if you're gonna hold it long-term, we need to know that from the beginning. There you have it, folks, our 5-2-1 formula. You now have the tools to help you make sound investment decisions, which is the first step to creating wealth through real estate investing. Again, it's a simplified version. I know you're gonna have more questions. Comment below, call me, I'd love to help. Thanks for watching. We'll see you next time.